Welcome to the free life insurance training videos brought to you by none other life insurance trainers. I'm Mark Miletello. So let's talk about replacing life insurance. You know, when I train new agents, this is something that is one of the sticking points of training. So let's jump into some things to think about when replacing life insurance. And you may need to watch this over and over and over so that you, when and if you're in a position of replacement, you understand what you need. So if you're replacing term, you need to find the date of issue. You need to find out how long the term length is. And so if it was issued 10 years ago and it's a 30-year term, then it's no longer a 30-year term, right? You're competing against a 20-year term now. That's why those two things are important. You need the health rating. It'd be nice to know what rating they got 10 years ago. To see what you're competing against, and you need to know the premium, of course. Now, what I've done really well at when and if it's ethical and appropriate to replacing a term, one thing you need to remember, and I do it on my own insurance, is layering. Laddering or layering, whatever you want to do. Consider layering, and you will be on the same side of that table as the consumer, because that's ultimately what they want, but they don't know that. In fact, most of the time when I talk about layering, the consumer tells me, I didn't know you could do that. And what do I mean by laddering or layering? I mean, in the next 15 years while my children are growing up are the most important years to have the most coverage possible. So instead of, let's say, having a $1 million 30-year lock, then maybe my needs constitute having double that for the first 10 or 15 years and having some of that fall off. So maybe I don't get to have that $1 million for the full 30. Maybe I only have $250,000 after 20 years because some of those coverages are falling off. I have 4 different life plans with most of my coverage in the early years. That's layering. And when you structure term life insurance like that, and you can blend in permanent, but when you structure it, makes sense. It gives them the coverage, more importantly, in those early critical years. And the consumers will appreciate the concept of saving them money and giving them the best coverage possible when they need it the most. So let's talk about a universal life insurance. Well, first of all, you cannot replace a universal, and it could be any universal, without ordering an illustration. Now, right now, we're really focused on kind of an indexed universal life here, or a variable universal life. But if you're replacing a traditional universal life, then you're just going to get an interest rate that they send you. But order an illustration at current premium to age 100. You know, a lot of companies will try to run this out to age 80, and they don't want to show you what happens after 80. It gets ugly. But if it's a fixed universal, of course, they'll send you the current interest rate. But if it's an indexed or a variable, you want to force the company to run it at a 7% so that you can compare like interest rates. So if the second illustration you're going to want to order is the needed premium to make it last forever, or at least till age 100 at 7%. So when I order any type of universal life comparisons, illustrations, I order 2. I order one that says, hey, if you never met me and you paid the same premium, I want to see what this thing does throughout your lifetime at 7% if it's an index or variable. And I also, if it doesn't, why do I need the needed premium to make it last forever? Because advising them to stay where they are might be part of this discussion. And I need to know, if I'm going to tell you to stay where you are, what do you need to put into this plan to make it last? Now, maybe it's better to start anew. I don't know that, but I need these two to make that ethical determination when replacing a universal life. Now, whole life. Careful. Replacing whole life is rarely beneficial. I have replaced many final expense plans. I've seen some plans where the cash value equals the death benefit, of course, but rarely do I see whole life plans needing to be replaced. A lot of times you can choose a reduced paid up option or offset the premiums with the interest, and those bad boys can continue on forever. But if you can, I mean, you must illustrate that you can completely beat a whole life all the way around and document that to make sure that that's ever in a client's best interest. So good luck, and we'll see you at the top of the charts.